Good evening, this is ENCA Moneyline, your money guide. My name is Sikim Gabateli. Coming up on the show tonight. South Africa's November manufacturing output takes a dip due to work stoppages. 1 out of 4 matrics are likely to get work. And in today's Investing 101, we take a look at investing offshore. But first, here are your top stories. Afrikaans Business Chamber AHI says businesses should prepare for the worst as a result of Eskom's problems. Government has formed a task team to deal with difficulties at Eskom. CEO of the AHI, Christopher van der Rede, says organizations involved in the energy sector should be included in the group. The power utility today told representatives of big business and stakeholders that it is concerned about the delays at Medupi and that it does not have enough power for South Africa.
Eskom CEO has alluded to the possibility of a national blackout. Obviously, that depends on whether government comes to the party, and secondly, if government does not come to the party, they will certainly run out of money. But the biggest fear at Eskom is that the existing infrastructure, that holds up for the next 6 months or the next 12 months. If anything happens now, then we're going to sit with a very, very serious crisis.
Work stoppages in the motor and mining industries led to reduced production last year. South Africa's manufacturing output dipped by 1.3% in November 2014. Stats SA says the number of vehicles, parts and accessories produced in the country went down as a result. Food and beverage production also contributed to the weak number. Despite this, seasonally adjusted manufacturing data was up 4.1% on the back of strong steel, vehicles and machinery products manufacturing. Seasonally adjusted sales of manufactured products increased 17 billion rand in the 3 months ended November 2014. China is defending its aggressive economic drive into Africa. Its Foreign Minister Wang Yi says Beijing will not engage in colonial-style takeovers in resource-rich countries. He's currently visiting the continent with stops in Cameroon, Equatorial Guinea, Sudan and the Democratic Republic of Congo. China has come under criticism for failing to boost African job markets. It's Africa's biggest trade partner with interests in oil, healthcare and infrastructure, among others. In 2012, China's trade with Africa reached $198.5 billion. The Department of Higher Education and Training announced an increase in funding to the National Student Financial Aid Scheme. Higher Education Minister Blade Nzimande says the government scheme will offer loans to the value of 9.5 billion rand this year. This is an increase from last year's 8.3 billion. Over 200,000 students, university students will be funded. 200,000 more students at technical and vocational education and training institutions will also benefit. Over 520 million rand has been allocated to fund scarce and critical skills. Not all matriculants who wrote the exams will be heading out to institutions of higher learning. Some will be heading out to the job market. However, there's little good news there, as economists have predicted that only 1 in 4 who are seeking jobs are likely to find them. This evening, we're taking a look at job prospects for the class of 2014 and the kind of skills that employers are looking for. And for that discussion, I'm joined in studio by Francois Stoffberg, who's an economist with the Efficient Group. Francois, thanks so much for your time this evening. That's a scary statistic.
It is very scary. The truth is that they did pass. It was good news, 75.8%. It's not a distinction, but at least they did manage to pass. I looked at the statistics, and 75.8% doesn't really tell us a lot. I prefer looking at something that shows me a more continuous growth in education. And what you do then is you compare the amount of students that passed with the amount of students who initially started in grade 1. And then you see the pass rate. It's not really a pass rate, but it's an effective rate of 32%. 32%.
Okay.
So that already shows us the long-term development. Another long-term development is, of course, Pearl's study of mathematics and sciences, which shows that South Africa is really doing very bad. If you look at the amount of students that wrote, 690,000 students, of those 150,000 or 28% can go to a tertiary institute, to a college or whatever, to attain a degree or a qualification.
Yes.
And let's assume 100,000 were already done and now they did an extra couple of subjects, or they're already unemployed or working, because what we want to get at is how many are entering the market now. And that leaves us with more or less between 390 and 440,000 new students or new people into the workforce. And the question is, can the economy accommodate them? Now, that's
we know the answer to that.
We know the
right?
answer. And
let's talk about what they're facing, right? Because we're already facing a huge youth unemployment problem in the country, but also among adults who have been retrenched from jobs. So we have a huge unemployment problem. Yes,
that's exactly it. We start off, we say unemployment in South Africa, we know 25.4%. That means roughly 3 out of every 4 people get a job. But remember, as you just said, they don't have the skills, they don't have the work experience. So there is a smaller pool. Statistics South Africa in their quarterly labour force survey, they say youth unemployment is more or less 36%. But that's a very broad definition. That's 2 out of every 3, but it's between the ages of 15 and 34. And that's a very large group.
Is a large
that means everybody is almost a child. What we should be looking at is the World Bank. They use an indicator for the group of ages 15 to 24. And then unemployment is 54%. See, now things are starting to get a bit tricky, but even then, we're comparing people that are 18, they just finished Matric, and we're comparing them to people that have a B degree, have an honours or even up to 5 years work experience. So that's where it gets difficult. That's who are they competing to, and that's why only 1 out of every 4 will probably get a job.
What is the value of a Matric certificate in the job market in South Africa today?
Currently, if you finished it and you got good marks and you can enter the job market, it is good. It can definitely help you. You can start a career, you can start an apprenticeship somewhere, but it is very difficult because you're competing with people that have been there for quite some time, that have been retrenched, as you said correctly, and then it gets very difficult. So yes, there is value, but not enough to get the job done.
What sort of skills are employers looking for? So if you've got this, let's say you've got your Matric certificate and you're looking for a job, how do you market yourself?
You're asking a very good question, and you're phrasing it well as well. There's a overemphasis on qualifications instead of skills, as you rightly said. We need skills, scarce skills. These are the artisans, these are the boiler makers, these are the turners and electricians, the apprenticeships. Those are the skills that the economy really needs to drive us forward. Yes, qualifications, yes, you need the doctorate students and so forth, but there is a very large pool of students that are called into these positions, and I would like to see students take on that and really go after these apprenticeships that we need to drive the economy forward.
And that takes me then to my next question around the structural problems within our labour market, right? And we're going to continue to have this conversation every January unless that is completely dealt with and we start to absorb those people who are perpetually unemployed.
Yes, that's a very good question. We talk about structural problems in the economy, specifically in the labour market, rigidities. Why aren't we seeing more people being accepted into the labour market? Why aren't the jobs being created? And the major reason is who drives jobs? Who should be driving jobs? Worldwide, business is responsible for 9 out of every 10 jobs. And in South Africa, that's not the case. In South Africa, we're constricting business to do what they do, and that is create jobs. So we should, in fact, actually try and make it more friendly for business and the companies that do employ more people, labor-intensive people, labor-intensive individuals.
And for young people, I mean, we've got the youth wage subsidies. That's the solution to our youth unemployment problem?
Not necessarily. I believe that's kind of like throwing money onto a fire. It keeps you warm, but it doesn't feed you.
Exactly.
Yeah. So that's what I feel about the youth subsidy. I would like, they just talked about the aid that goes out to students, and there are a lot of aid opportunities. The first thing that you have to do is you have to start working very hard. You know there's a problem with work in South Africa. If you can keep on excelling, keep on pushing yourself forward, you can make it. You need a textbook, that's what you need. You need a textbook and you need the effort to put in and then make it and get the qualifications, get the skills that you need to take you forward.
We'll leave it there. Thanks for your time today. Francis Stoffberg is an economist with the Efficient Group. After the break, we take a look at investing offshore. You're watching ENCA Moneyline, your money guide. Do stay with us. Welcome back. Now, on tonight's Investment 101, we tell you about investing offshore, essentially, how to invest some of your money on markets outside of South Africa. I went off to look at the different options available to you and, of course, the benefits and the risks. Any financial planner will tell you that when investing, it's important to not have all your eggs in one basket. This is what's called diversification in investment speak. There are many ways to achieve this. You can put your money in different asset classes like bonds, shares, property, or the good old bank. But South Africans are increasingly looking offshore.
At this point in time as well, we've got international markets and international economies performing a lot better than South Africa. And so in that respect, I think at this point in time, it certainly also makes sense for South African investors. Also, I guess, when the rand depreciates, you tend to get some of that benefit as well in terms of being in an offshore jurisdiction.
But as with any investment, there are risks associated with taking your money offshore.
A lot of South Africans don't know that much about international investing, and so as a result there's a much higher or steeper learning curve. There are also, I guess, additional costs from a South African perspective, bearing in mind we've got exchange control, so you don't have this unconstrained ability to invest offshore.
Exchange control restrictions limit the amount of money investors can take outside the country. Up to 4 million rand may be invested offshore every year. This is all subject to tax clearance from the Reserve Bank and up to 1 million rand a year without tax clearance, although the investment needs to be registered with the Reserve Bank. A retail investor with maybe 1,000 rand to spare has numerous instruments that you can use to invest offshore.
The first one would be through what is called an asset swap fund. That is a unit trust, a collective investment scheme. And you'd find that at any of the major investment houses in South Africa. Effectively, as a South African, you'd put your money into a South African domiciled fund, and that fund would then invest on your behalf in international markets. The key distinction is when you actually invest and then divest from that fund, you're putting in rands and you're getting rands out as well. So what you're getting is effectively the performance of the international market and then also the exchange rate overlay on that.
The second mechanism would be through exchange-traded funds, which suits investors who are more passive in nature. These you can get through your stockbroker. As with any investment, you must consult your financial advisor before making any decision. Now, the dramatic drop in Sasol's share price has some investors worried. Sasol stock has come off a high of 645 Rand 10 cents a share in June last year, when the price of Brent crude was around $116.12 a barrel. Today, Sasol's shares ended trade at 381 Rand 80 a share, with Brent trading at around $48 a barrel. What then about the over 200,000 Sasol Inzalo shareholders? They, of course, received their first dividend last year. Their BE scheme still has a pile of debt. Maudi Nzwane of Luhumo Capital is here to help us answer that question. Hi, Maudi, thanks for your time this evening. Over 200,000 investors in this scheme, watching this share price falling. Before we talk about the impact of the share price itself, let's just revisit quickly what the scheme was that was launched in 2008.
100%. I think it's a gloomy picture, I must say, for those investors who obviously took part in the Black Economic Investment Scheme back in 2008 when it was launched. Basically, when it was launched, the scheme comprised of two schemes. The one portion was the cash invitation. In other words, you actually bought the shares, the actual shares of Sasol at a discounted price. Yes. And the other portion was the funded invitation, where I think the price was around 22 Rand that they had to pay for share price, which was trading at the time at 400 Rand. Yeah. So they had got a massive discount, but that discount was not for free. They had to fund it with a debt.
Yeah.
So they currently, for the duration of the scheme, they're currently paying off that debt with the dividends that they're receiving from Sasol.
Okay, so you're sitting with debt, right? And we are in an interest rate rising environment. I mean, we're not expecting a rate hike, in the next in the short term because of what the oil price has done. But that must be having an effect on debt repayment.
No, most definitely. I think the big negatives for that funded invitation was the interest rates risk, which is obviously the big risk for them. If interest rates start rising, of course, that means the repayment on that particular debt increases. But also the other risks, of course, is the very same thing that affect the cash invitation, which is your oil price and the currency risk as well. You know, if the rand depreciates or appreciates quite significantly in the case of Sasol, that impacts negatively on the share price. So the risks are exactly that the interest rates. At this point in time, I think we have not really moved too far away from the interest rates. Yeah, so it hasn't really impacted them. The big impact comes from the recent fall in the oil price.
Let's talk about this stock coming down from what was the number I quoted? 645.
Absolutely. I mean, it's a drop of over 50%, close to 50% in a period of 6 months. That's a dramatic fall. I must say, it's a mirror image of what has actually transpired on the oil market. You know, the oil price took a nosedive to currently just trading below $50 a barrel. You know, that's the story of obviously things that we've been talking about. You know, the slowdown in the global economic growth, and because of China slowing down, a big impact there. But I think the recent fall that we saw beginning of this year with 2 days of consecutive 5% drops.
Yeah.
It's as a result of what is happening, a tug of war between Saudi Arabia and the US. Saudi Arabia wants to take out the shale sector or the shale industry in the US. And I think they're really, really aggressively coming out very strong to push them down. And that's what has actually led to this recent drop in the oil price.
How long could this play itself out? Because obviously Saudi Arabia is the most influential member of OPEC, but not the only one. Surely the others are going to feel a lot more pain and start to actually push them for some sort of action on cutting output.
Indeed. Look, I might be very controversial here, but I think that's basically the function of a cartel. I don't think, if you listen to what has been happening, the other members are quiet. It's because, you know, they hedge themselves far out, 12 months out. So they're currently still okay at this present moment because they've hedged themselves.
Yeah.
So that's why they're not actually saying anything. And they're actually liking what is happening, which is to try and take out the entire US shale industry. Those are the ones that cannot sustain, of course, because these are individual companies that are operating, and most of them are highly leveraged.
Yeah.
So they will not sustain these current prices, and they are the most likely to blink first. So that tug of war, it's likely to be won by the OPEC members.
I mean, I'm thinking here of countries whose entire fiscus depends on oil revenue. So there may just be some pressure from citizens as well.
Certainly, but I think that pressure will be felt out a year from now, not necessarily at this current moment. And I think by that time, you know, everything would have actually resolved itself, and we'll start seeing the oil price. I don't think the oil price will remain at this low level for a long time.
So investors must just cross fingers.
I think it's going to be, there's a silver lining at the end of this dark cloud.
I'm going to hold you to that. Moneyline is with Luhumo Capital. Our daily question and answer feature is up next. Stay with us. It's time now for our daily Need to Know feature. We have a team of experts ready to answer all your questions about money, finance and the economy. No such thing as a stupid question. Tonight's question is from Lindiwe, who wanted to know, do retirement contributions increase on a yearly basis, and what determines that increase? Tracy Jansen, who is product architect at 10X Investments, answered this question for us.
If you look at retirement contributions, it depends whether you're saving through your company or if you're saving by yourself as an individual. If you're saving through a company, then you normally pay a percentage of your salary. So say somebody who's earning $10,000 a month and they pay 10%, they would contribute $1,000 a month. And then like next year, maybe their salary is $12,000, then they would be paying automatically pay $1,200. So it would grow with their salary. But if you're an individual and you're saving in what's called a retirement annuity, then you tell them what percentage to pay. So there, it's not linked to your salary. You say R1,000 a month, it will stay that until you pick up the phone or send them an email and say, I want to up my contribution. So it's not linked to your salary. Some retirement annuities will ask you if you want it to be linked to inflation. So it depends whether you've checked, I want it to grow with inflation, or if you've just put a rand amount in.
And that's it for today's edition of ENCA Moneyline. You can get in touch with us via email on moneyline@enca.com. Tweet us using the handle @ENCA News with the hashtag ENCA Moneyline. We'll see you tomorrow. Good night.